And here's something that a lot of people just don't get when they're thinking about the yields of these different, there's three types of companies that I mentioned. And that is, they're forgetting the valuation. Let me give you an example. So a super high yielding company, it's actually often not that it's just paying a huge dividend. It's often paying a dividend, yes, a high portion of its profits as a dividend, but because that company often is mature and low growth, maybe doesn't have many prospects, the valuation of that company is also typically low. It's probably got a low PE ratio. And so if you think about that, the dividend yield is calculated as the dividend payments out of the share price or the market cap. And so it's not surprising that those companies end up having very high yields naturally, because actually their valuations are very low. And the counter to that, again, would be on the opposite end of the spectrum, a company that's growing really well and one that's valued highly. They also are paying a dividend, usually quite a decent portion of their earnings out, but because they're valued so highly, that yield is actually quite low. Investors value their earnings maybe at a high PE ratio, and it's difficult for them then to compare on that yield basis. And so what this means is that the very best companies, the best dividend paying companies, are not the ones, generally speaking, that are paying these crazy, 7, 10% yields. They're the ones that are just fundamentally great quality businesses that are growing really well. And I think that's the most important lens. And so those are the ones that if you can find them, that's what will create an absolute superpower for dividend portfolio. You might be thinking, Al, how am I going to build a great dividend portfolio if the yield is only 2%? That's just not going to work. And you're right. It would take a very long time if you only had that 2% yield to build up a monster or an absolute killer dividend portfolio. What people are missing here is that depending on the type of companies you go for, and let's assume you're going for that type 2, the one that's growing and has a dividend payment, is that those companies hopefully are going to grow. So your initial investment will grow, and with it will grow the dividends. And so after a while, that what might have started off as a 2% yield could actually start to look like an 8 or 10% yield. But that is happening because the company is growing and the market cap of the company is growing. If you think about it for a second, it would be very strange for a company to just keep increasing its dividend payments over time, but not have the corresponding value of an increase in market cap. It would, after time, it wouldn't be able to sustain it.